No. So this is typically what you might see in practice. Initially, a firm engages in international trade, and when they realize that it's a good market, they get more confidence, they typically try to enter into a joint venture with a partner based in that country, and after that, in the third step, they might acquire the local partner. So this way, by doing it in a staged process, they are taking less risk, and it's a much more safe process. It can also be a more conservative process as far as the US company is concerned. Okay? So here, what it talks about is that this shows you the ways in which money comes from the foreign subsidiary to the parent company. So what we have is that a cash inflow from exporting, okay, and cash outflows to pay for importing. So let's say you are Walmart, you're importing products from China, you will have a cash outflow. On the other hand, if you're a Microsoft, you are selling your products to outside countries like Europe, you typically might get a cash inflow from the exports. Now the next one is licensing, franchising, and joint ventures by the multinational. So here, cash inflows from the services provided. So let's say you're a Marriott hotel or you're a Hilton, chances are you have operations all over the world, and typically they tend to be franchisees who operate Hilton hotels or Marriott hotels across the world. And the parent company provides some know-how, and for that the parent company gets paid a certain percentage of the profits. They also get a certain percentage of the revenues. At the same time, there can also be cash outflows for services that are purchased from outside. Okay? And the last one is investment in foreign subsidiaries by the multinational. So let's say GM sets up operations in China, then what we have is cash outflows to finance the operations. So GM has to incur substantial investments, especially initially, to set up the operations, and after that there could be cash inflows from the remitted earnings. So as we said before, as far as US multinationals are concerned, one of the biggest problems they face is how to bring the money they make from other countries back to the US. And the reason why they are concerned is because the US is one of the few countries where the multinational has to pay taxes on foreign income. So most of the countries, other countries do not require that. And this is also one of the reasons why in recent times we see a lot of US-based companies are slowly moving to other countries with a lower tax rate. So previously they used to move to countries like the Cayman Islands, and in recent times they are moving to Ireland because Ireland has lower taxes, and some of the companies such as Wendy's are moving to Canada, again because the taxes are relatively lower in Canada. Okay. So now we want to talk about some examples, and we want to talk about why companies make some decisions such as this. Okay. So the first one is Dewey Incorporated decides to penetrate the Spanish market with either a licensing arrangement with a local firm or by acquiring a foreign firm. So they have a couple of choices. One is a licensing with a Spanish firm, or they might want to acquire a Spanish firm. And basically here, what we are saying is, which is better if the product is successful, which is riskier? So to answer the first question, which is better if the product is successful, if they know that the product is going to succeed, it's better to acquire a foreign firm. And the reason why it's better to acquire the foreign firm is because in that case, all the revenues and especially all the profits come back to the parent company. Now, which is riskier? Clearly, if you have a licensing arrangement with a Spanish firm, you are taking less risk. Because in this case, even if the product fails, you don't have much at risk. You're not making a big investment, and because of that, you don't have to worry about huge losses. So that is why we say that the licensing arrangement is less risky, or the acquisition is going to be a riskier strategy. Okay? The next one, Snyder Golf, a US firm that sells high-quality golf clubs in the US, wants to expand to Brazil. And should the firm export, license, or set up a subsidiary? Okay, so these are the choices. And basically here what we are saying is that usually if you are Schneider, what you might want to do is that initially you might want to test the market to see whether there is going to be sufficient demand for your products. And how can you do that? One of the ways is they might want to export. And once they realize that the exports are good, there is sufficient demand for their products, then they might want to think about establishing a subsidiary. And why should they do that? So there are some reasons why they might want to do that. The first is the wages in Brazil are lower, which means that if they can make the same quality products that they make in the US, they will have a higher profits because of the lower cost of goods. Okay. Now let's look at another example. Carlis is a US firm that is about to purchase a large company in Switzerland at a purchase price of 20 million. This company produces furniture and sells it locally in Switzerland and is expected to earn large profits every year. The company will become a subsidiary of Carlis and will periodically remit the excess cash flows due to the profits to Carlis company. Assume that Carlis company has no other international business. Carlis has 10 million that it will use to pay for part of the Swiss company and finance the rest of the purchase with borrowed dollars. Okay. So here, Carlis can obtain supplies from either a US supplier or a Swiss supplier, in which case the payment would be made in Swiss francs. Both suppliers are very reputable and there will be no exposure to country risk when using either supplier. Is the valuation or the total cash flows more uncertain if it obtains the supplies from a US firm or a Swiss firm? Explain briefly. So what we see here is that this is primarily a US firm that is making a big investment in Switzerland, and what we see here is that most of the money they make comes from their business in Switzerland. So there, all the cash flows they get, again, is in Swiss francs. So if they finance the money from the US, what that means is that they will have a higher exchange rate risk. And the reason being that the revenues are in Swiss francs while their financing, most of the costs are incurred in US dollars. So rather than do that, it might be more useful or more helpful for this firm if they finance in Swiss francs. And this way, part of the revenues that they get, they can use the money to make the payments on their the loan that they have taken to make the purchase. So that's the reason why the valuation of the total cash flows will be less uncertain if they obtain the financing in Swiss francs rather than obtain the financing in US dollars. Okay. So the last thing we want to talk about is we want to talk about the valuation for a multinational corporation. And usually when you talk about valuing a US firm, in corporate finance what we said was the value of the firm is the present value of the future cash flows. So in the case of the domestic, what we need to have is we need to have cash flow projections. So cash flow dollar at time t. So we are talking about the cash flow today, the cash flow the next year, and so on. These tend to be the cash flow projections. And then we also want to have the cost of capital, so here K, that represents the required rate of return by investors. And typically in finance, we refer to that as the cost of capital. So the value of a firm is the present value of the future cash flows. So to increase the value of a firm, there are two ways you can do that. The first is you can increase the future cash flows. The second is you can decrease the cost of capital. So to increase the future cash flows, you want to take better investments. So that is the capital budgeting decision. And to bring down the cost of capital, that mainly comes from the financing decision. So should we finance with bonds? Should we finance with stock? And should we issue the stock in the US? Should we issue the stock abroad? And so on. So these are typically the choices you have to make when you talk about valuing a domestic firm. Now, what we also want to see is that what happens when a firm goes abroad. So when a firm goes abroad, the big difference is that rather than receive all the money in US dollars, the firm might receive the money in different currencies. So the firm might receive money in euros, the firm might receive in Indian rupees, the firm might receive in Brazilian currency, it might receive payments in Mexican pesos, and so on. So what we have here is that we have the cash flow at time T in currency J, and we also want to multiply it by the spot rate at that time. So the spot rate, that represents the exchange rate at a later time. We're talking about spot rates at different time periods. So basically here, we are saying that the cash flow you receive, for example, in Mexican peso, the next year, we want to multiply it by the spot exchange rate that will be there in the next year. So when a company goes abroad, the main issue it faces is it gets paid in different currencies, and here what we find is that not only does the firm have to worry about the future cash flows, it also has to worry about the future exchange rates. So that can affect the value of the firm. So what are some of the factors that can affect the cash flow? Here, what we are saying is that in 2008, when we had the crisis in the US economy was rather down, the value of the dollar was also down, and what we found was things were great in Europe, in Asia, and so on. So at the time, US multinationals were more profitable than ever. But today, what we find is that things are different. The economy is not doing good in Europe, economies are not doing good in Asia. At the same time, the US economy is doing very good. So there, what we find is that if you are a US multinational, your cash flows might be going down simply because business is not that great in Europe. Okay? That's one thing. The second is exposure to international political risk. And what we are saying here is that if you look at a country like Venezuela, overall the country is not doing well, and the country has put a lot of restrictions on transactions, especially in foreign exchange, and they're also not allowing free repatriation of money from Venezuela to other countries. So that is an example of international political risk. And the last one is exposure to exchange rate risk. And what we are saying is that the business might be okay as far as the foreign country is concerned. So in the local currency, that could be in euros, you are getting the same business, you are having the same revenues. But right now, what we find is that the value of the euro has declined against the US dollar, which basically means that when you convert the foreign cash flows back to US dollars, you're going to have fewer US dollars. So that is an example where you have exchange rate risk, and that is going to bring down your cash flows. Okay? So we want to talk about, we already finished chapter 1, and chapter 1 gave us a big picture of the international firm, and we talked about some of the reasons why companies go abroad. We talked about the agency problem. We talked about the different ways you can set up a business, and we also talked about some of the risk a company faces when they go abroad. Now, what do we do in later chapters? So chapter 2 to 5, we're going to talk about the big picture. We're going to talk about the financial markets. So we will talk about the background of the international financial markets. That's what we do in chapters 2 to 5. And chapter 7, we talk about the different types of debt. We will talk about the exchange rate behavior. So there, chapter 6 to 8, we'll talk about international arbitrage. We will talk about purchasing power parity, and so on. So that's what we see. Exchange rate risk management, we do that in chapters 9 to 12. So there, we will talk mainly about hedging foreign exchange risk and how we can use derivatives and so on to hedge your foreign exchange risk. After that, we cover the risk and return of an MNC, and we'll also talk about the short-term investment and decision. What we see here is that all these activities can affect the value as well as the stock price of the MNC. Okay? So before we finish this chapter, I want to talk a couple more things. And the first here is we want to talk about Anheuser-Busch. So Anheuser-Busch is a producer of Budweiser and other beers, and that was a US company till very recently, and in recent times they have been bought by a foreign company, and that is InBev. And in this case, what we are seeing is that Anheuser-Busch wants to expand into Japan by engaging in a joint venture with Kirin Brewery, the largest brewery in Japan. The joint venture enables Anheuser-Busch to have the beer distributed through Kirin's distribution channels in Japan. In addition, it can utilize Kirin's facilities to produce beer that would be sold locally. In return, Anheuser-Busch provided information about the American market to Kirin. So what we see is that Anheuser-Busch has the opportunity to go to Japan, and to do that, rather than set up their operations independently, they are entering into a partnership with Kirin, which is one of the largest breweries in Japan. And to get that exposure to the Japanese market, what Anheuser-Busch is also doing is that they are going to share their know-how of the US market with Kirin Brewery. And here, what are some of the questions here? Explain how the joint venture enabled Anheuser-Busch to achieve the objective of maximizing shareholder wealth. So what is the benefit of the joint venture? The main benefit is that it enabled Anheuser-Busch to distribute Budweiser throughout Japan. This was achieved without a significant investment. So here, if Anheuser-Busch had gone alone, chances are they had to set up manufacturing in Japan, which would have been very expensive. And the second is that they also would have to have a distribution network in Japan that also would be very difficult and very expensive. So they were able to avoid both these costs by having a partnership with Kirin Brewery. So that is what we see here, and explain how the joint venture limited the risk of the international business. So the main risk is the big investment that Anheuser-Busch would have to make in terms of manufacturing and in terms of a distribution network. And in this case, Anheuser-Busch was able to make a much smaller investment by tying up with Kirin Brewery. And by tying up with Kirin Brewery, they also got the distribution network that Kirin Brewery had, so that would save them a lot of money in terms of also a lot of time that they would have to spend in setting up the operations. Okay. Now here, many international joint ventures are intended to circumvent barriers that normally prevent foreign competition. What barrier in Japan did Anheuser-Busch circumvent as a result of the joint venture? What barrier in the US did Kirin circumvent as a result of the joint venture? So what is the biggest barrier? The biggest barrier is a distribution network, and in this case, for Anheuser-Busch, they were able to benefit from Kirin's distribution system. And as far as what is the risk they face, the risk is that Kirin can get the know-how regarding the US markets from Anheuser-Busch, and then they can use that to enter the US market and perhaps compete with Anheuser-Busch. Okay? So that is what we see. The next example is Olmsted Company has a small computer chips assembled in Poland and transports the final assembled products to the parent, where they are sold by the parent in the US. So we are talking about a US company setting up operations in Poland, and what we see here is that the assembled products are invoiced in dollars. Okay? It uses Polish currency to produce these chips and assemble them in Poland, and the Polish subsidiary pays the employees in the local currency. Olmsted Company finances the subsidiary operations with loans from a Polish bank, and the parent company will then send sufficient monthly payments to the Polish subsidiary in order to repay the loan and other expenses. If the Polish zloty depreciates against the dollar, will that have a favorable, unfavorable, or neutral effect on the value of Olmsted? So what we see here is that we are talking about a US company, and as far as the US company is concerned, their revenues are coming in US dollars, and when you look at their cost, most of the costs are incurred in Polish currency. So what we see here is that Their wages they pay to the employees are in Polish currency, and they also borrow in Polish currency. So most of the costs are incurred in the Polish currency. So whenever we have, the scenario in this case is the Polish zloty depreciates against the dollar over some time. So if this is going to happen, that will actually help the company. And the reason why it will help the company is because the revenues are invoiced in US dollars and the cost of goods sold is invoiced in Polish zloty. So